first one is the childcare centres, and there's two stocks that in the AREIT market that invest in childcare centres specifically. It's an interesting area because childcare centres usually achieve 10 to 12 year leases, so they're very long-term leases. People value them quite highly at the moment. Cap rates have been coming down. It's a very popular asset class. Those stocks trade at a premium to their net tangible asset backing at the moment, as compared to some of the other sectors that trade at discounts. So they're not particularly cheap. The other thing to consider in that market is that there is a fair bit of new supply coming onto certain parts of that market, which is always a bit of a concern. And also, we have to be mindful that you have to keep an eye on how the underlying operators are going, especially in a growing supply market, and whether the profitability ratios are still keeping up or whether they're in fact deteriorating as a result of new supply, new competition. So it's one that we're currently underweight. We don't hold those stocks at the moment because they're a bit expensive to us, being at premiums to NTAs. But it's one we do keep a close eye on, and when there are opportunities we may look at it from time to time, but right now we're out of that sector. The other subsector that is interesting is the suburban office markets, and mainly because those stocks that have been exposed to suburban office markets are still trading at around NTA, some a little bit above, some a little bit below. They have quite high yields, but also they're benefiting from the spillover, particularly in Melbourne and Sydney, of the tightness in the CBD markets. So suddenly demand starts to spill over into the suburbs where rents are a little bit more affordable, and rents start to go up in the suburbs as well. Vacancies come down, and so those markets start to perform with a lag to CBD markets. So that's been an interesting area for us. We found good yields, and therefore we have been overweight in those stocks. We include the smaller cap names in our portfolio in a very similar way to all other stocks in the portfolio. The first thing we look at is, are they valued? Do they represent good investment value to us? We look at the sectors they're exposed to. Do we like the fundamentals in the sector, in the subsector, like for instance the suburban office markets? And then we look at the liquidity and size of the stocks so that we can take appropriately sized positions given the liquidity and the size of the market cap of each stock. So what we're trying to achieve is a portfolio approach to investing in the small cap stocks and trying to invest in the ones where we have the strongest conviction.